3 days, that is all that stands between the silver market and the most consequential delivery window in modern commodity history. The April 2026 COMEX first notice day arrives in exactly 3 business days, and right now, as you are watching this, 1,830 contracts representing 9.2 million ounces of physical silver are still standing open. Nobody rolled, nobody blinked. And the metal sitting in those vaults, the metal that is supposed to back every single one of those contracts, has been disappearing at a rate that should terrify every paper trader on the planet. This is OG John AG, and if you have been following this channel, you already know we do not deal in hype. We deal in numbers, we deal in vault reports, we deal in the raw, unfiltered data that the mainstream financial press refuses to put on your screen. And today's data is so alarming, so structurally significant, that I need you to hear every single word of this video from beginning to end. If this is your first time here, consider subscribing. Not because I am asking for a favor, but because what you are about to hear will change the way you look at silver for the rest of this cycle. And if you leave now, the algorithm will never show you this again. You are going to hear a lot of numbers in this video. Some of them will sound impossible. Some of them will sound like they belong in a dystopian financial thriller, not in a real-time market report. But every single digit I am about to give you comes directly from CME Group warehouse reports, LBMA settlement data, and official trade filings. I did not round them. I did not adjust them for dramatic effect. The facts do not need my help being dramatic. Let me give you the number that keeps me awake. 131 trading days. That is how long COMEX has before its entire registered silver inventory hits zero at the current withdrawal pace. Not years, not decades. 131 sessions. Registered silver has declined 13.2% in just the last 30 days alone, 11.6 million ounces physically pulled from those vaults. The coverage ratio, the metric that measures how much real deliverable metal exists relative to the paper promises floating above it, has collapsed to 13.5%. And the paper leverage sitting on top of that shrinking pile of metal, 7.4 times. For every single ounce of silver that COMEX can actually deliver, 7.4 ounces have been promised on paper to someone who believes they own it. Now let me zoom out and show you how we got here, because the price action this week is telling a story that most people are reading completely wrong. On March 26th, silver closed at $67.75 per ounce. That is a $4.85 drop from the previous day. On March 25th, it was $72.60. On March 24th, $70.13. March 23rd, $69.39. This week alone, silver has been whipsawing between 66 and 73, and if you only look at the spot price, you would think the metal is dying. You would think demand has evaporated. You would think the story is over. But the vault data says something completely different, and both of them cannot be right at the same time. Here's the context that transforms everything. On March 2nd, just 25 days ago, silver was trading at $97.30 per ounce on LBMA. Today it sits near 67. That is a 37% collapse in less than a month. And yet during that exact same period, physical metal has been leaving COMEX vaults at an accelerating rate. Registered silver broke below 90 million ounces in February. On February 11th, COMEX reported a single-day withdrawal of 3.26 million ounces from the registered category and another 4.7 million ounces from the eligible category in one session. Total COMEX inventory has declined 31% since October 2025. Since 2021, registered silver, the only metal that can actually be delivered against a futures contract, has dropped by more than 70%. So if the shortage is this severe, why is the paper price still collapsing? Hold that question. The answer is worse than you think. Let me take you inside January 2026 first, because what happened in that single month rewrote the rulebook for the silver market. In the first 7 days of January, 33.45 million ounces of silver were physically withdrawn for delivery from COMEX. That is 26% of the entire registered inventory, gone in 1 week. January alone settled 49.4 million ounces for physical delivery, more than 7 times what January 2024 produced. The entire year of 2025 settled 474 million ounces. The year before that, 203 million. Deliveries are not declining. They are exploding exponentially. And here is the name you need to remember. Sprott Physical Silver Trust doubled its capital raise program in January 2026 to $2 billion. At the prices at that time, that single institutional move could absorb approximately 18 million ounces of physical silver, roughly 16% of COMEX's registered inventory in one transaction. Sprott is not melting silver into solar paste. They are not manufacturing electronics. They are pulling physical metal out of the system and locking it away in allocated vaults because they no longer trust the paper market to deliver. And they are not the only ones. JP Morgan issued 99% of 8.1 million ounces in delivery notices on a single day in early January. But here's what made the data truly abnormal. Despite those massive deliveries clearing, open interest on the same contract increased by nearly 1,500 contracts on the exact same day. New buyers were arriving faster than metal was leaving. The demand pipeline is not draining, it is widening. And there is a new player in this manipulation conversation that most people have not heard about yet. Reports have surfaced that a billionaire Chinese trader has built the largest net short position in silver on the Shanghai Futures Exchange. Using Bloomberg data and expert commentary, analysts are now exploring how a single massive short position may be impacting global silver prices. And the critical detail is that this volatility is originating from China, not from COMEX. The silver market has historically been dominated by a handful of concentrated short positions. The fact that the largest current short is sitting on the Shanghai Exchange rather than in New York adds a layer of complexity that most Western-focused analysts are completely missing. Meanwhile, China's imports of unwrought silver ingots with a purity of at least 99.99% surged to 206.76 metric tons in February 2026, up 4.99% month over month, and an astonishing 5,910% year over year. That is not a rounding error. That is a multi-year high that reshaped the entire supply-demand pattern for the domestic Chinese silver market. The import window opened because Chinese spot premiums spiked so high that it became profitable to ship metal from the west to the east, and massive volumes moved. Now layer on top of that what China did on January 1st, 2026, and the picture becomes almost impossible to ignore. China formally reclassified silver as a strategic material, placing it under the same export control framework as rare earths. Only 44 companies in the entire country have been approved to export silver under the new licensing system for 2026 and 2027. Exporters must now produce a minimum of 80 tons of silver annually and maintain $30 million in credit lines just to qualify. The result? An estimated 40% reduction in Chinese silver exports compared to the previous year, at a time when China controls between 60% and 70% of the world's refined silver supply. This is the rare earths playbook applied to a monetary metal. And here is what most Western analysts are still ignoring. China is not just a net exporter of refined silver. It is the world's dominant gatekeeper to newly mined silver worldwide, thanks to its massive refining infrastructure. In totality, when you count silver ores and concentrates, China is actually a net importer of silver. In 2024, China exported roughly $3.8 billion of refined silver, while importing approximately $5.57 billion in silver ores and concentrates. They import the raw material, refine it, and control the global supply of the finished product. And now they have locked the exit door. The solar industry in Europe and the United States is under particular pressure because China controls a dominant share of refining capacity. Without refined silver from China, the production of photovoltaic modules and high-performance chips faces direct supply disruption. Initial reports suggest that major technology corporations are now attempting to buy directly at the Shanghai Gold Exchange and import the metal via circuitous routes at vastly inflated costs. And the United States added silver to its own nationally designated list of critical minerals in November 2025, citing its use in electrical circuits, batteries, solar cells, and antibacterial medical instruments. Both superpowers now classify silver as strategically essential. Neither is willing to let it leave their borders freely, and the global market has to figure out how to function in a world where the largest refiner just pulled the exit door shut. In a moment, I am going to show you a single data point that completely changes how you read everything I just said. But first you need to understand the January 30 crash, because that event is central to every conspiracy theory and every structural argument currently circulating in the silver market. On January 30th, 2026, silver suffered its largest single-day percentage drop since the Hunt brothers collapse in 1980. The price plummeted from $121 to $74 in a single session, a $47 intraday collapse that wiped out over $3 trillion in combined gold and silver value in less than 24 hours. The trigger? CME Group shifted from fixed dollar margin requirements to percentage-based margins. Initial margin for March 2026 silver contracts jumped to $25,000 per contract. Smaller traders without sufficient capital were automatically liquidated. Chinese futures markets, where margin requirements were as low as 2.5%, cascaded into margin calls that spread through the entire system. Algorithmic funds in the U.S. accelerated the decline by targeting stop-loss levels. Indian companies holding paper bets, not physical bars, were wiped out in hours when the exchange moved the goalposts. Refiners stopped bidding. Wholesalers refused to pay up front. Coin shops in the United States offered as much as $15 under spot, while simultaneously promoting fear-based narratives about supply collapse. The entire physical supply chain locked up while the paper price cratered. This was not a demand problem. This was a leveraged liquidation event amplified by structural fragility in the paper market. And the gap between paper pricing and physical market behavior became too wide for anyone to pretend it was normal. And here is where the conspiracy angle gets teeth. 5 major banks have been criminally charged and fined a combined $1.2 billion for manipulating silver markets through spoofing and price rigging. JP Morgan alone paid $20 million in 2020 and admitted wrongdoing to the U.S. Department of Justice. Scotiabank settled for $127.5 million. HSBC paid $76.6 million for spoofing between 2011 and 2020. Deutsche Bank paid $75.5 million for silver fix manipulation dating back to 1999. Morgan Stanley paid $1.5 million for spoofing between 2013 and 2014. These are not allegations. These are settlements. These are admissions. And the question that every silver investor is asking right now is whether the exact same mechanics are being deployed again in 2026, dressed up in different language. The Gold Antitrust Action Committee, founded in the late 1990s, has spent decades collecting official records, central bank communications, and policy documents that they argue demonstrate a consistent effort by Western governments to influence precious metals prices. Their position is that government intervention in gold and silver is not only real, but legally authorized under existing statutes. And when you look at the pattern, margin hikes that coincide precisely with moments when physical delivery demand threatens to overwhelm the system, the narrative carries just enough documented precedent to make dismissing it intellectually dishonest. Now here's the data point I promised you: silver lease rates. In normal years, when supply is abundant, 1-month silver lease rates hover between 0.3% and 0.5%. By January 2026, that rate exploded to 8%. That is not a typo. 8%. Someone is willing to pay 8% annualized just to borrow silver so they can guarantee delivery on time. That number alone tells you more about the true state of the physical market than every futures chart on every screen and every trading desk in New York combined. When borrowing costs spike 20 times above normal, the metal is not available. Period. The leasing market is the canary in the coal mine for physical silver. And that canary stopped singing in January. And there is something else happening that the Western financial press has barely covered. The March 2026 futures contract alone represented over 500 million ounces of silver, more than 4 times the total deliverable supply in COMEX vaults. The paper-to-physical ratio across the broader system reached 356 to 1. For every ounce of real metal, 356 ounces were promised in paper form. The entire system functioned on one assumption, that nobody would ask for their metal all at once. In early 2026, that assumption broke. The LBMA, the heart of global spot silver trading, carries its own credibility scar. In 2021, the association overstated its silver holdings by approximately 300 tons. They called it a calculation error. The market called it something else. And by 2025, LBMA's eligible silver stocks had shrunk to only about 155 million ounces, while annual demand was running between 900 million and 1.2 billion ounces. Meanwhile, Shanghai physical silver has been trading at premiums as high as $130 per ounce, when COMEX was quoting $92, a 40% divergence between the paper price in New York and the physical price in China. That gap has narrowed since, but it has not closed. And until it does, the two-tier pricing system that the silver market has become is a neon sign flashing one word: fragmentation. Pull up CME Open Interest right now while this video is playing. Tell me what you see, because what I see should not be possible at this stage of the cycle. The backwardation signal is the cherry on top of this structural mess. Silver is currently trading in backwardation, meaning the spot price is higher than the futures price. This is the market telling you in its own language that physical metal today is worth more than a promise to deliver metal tomorrow. Backwardation in silver is rare. Sustained backwardation during a period of vault drawdowns, lease rate spikes, and strategic export restrictions from the world's dominant supplier is something that has no modern precedent. Now here is the part where I owe you intellectual honesty. Not everyone reads this data the same way. The bearish case against silver is real, and it deserves respect. Silver just experienced one of the most violent speculative blow-off rallies in commodity history, surging more than 135% in 2025 alone. The January 2026 spike to $121 had all the hallmarks of a parabolic blow-off top: record SLV ETF volume, extreme retail participation, over-leveraged Chinese futures positions, and price action that looked more like a meme stock than a 5,000-year-old monetary metal. The Bank for International Settlements, in their March 2026 quarterly review, characterized the January spike and crash as a classic boom-bust driven by speculative excess, not a durable repricing of fundamental value. CME margin hikes are not necessarily manipulation. They are a standard risk management tool that exchanges deploy when volatility exceeds safe parameters. U.S. Treasury Secretary Scott Bessent attributed the extreme swings to Chinese traders, describing the rally as a speculative blow-off. And there remains plenty of eligible silver and COMEX vaults that could be converted to registered if the price incentive is sufficient. The bearish case says this is a correction within a speculative cycle, not a structural revolution. That argument has historical precedent, and it would be dishonest to pretend it does not exist. But here is what the bearish case cannot explain. 5 consecutive years of structural supply deficits. 2025 alone produced a shortfall of over 230 million ounces, roughly equivalent to Mexico's entire annual output, and Mexico is the world's largest silver producer. Global demand reached an estimated 1.24 billion ounces last year, while total supply, mine production plus recycling, delivered only 1.01 billion. Those are not speculative numbers. Those are Silver Institute survey numbers, and they have been moving in one direction for half a decade. The geopolitical dimension is accelerating every structural trend. The Iran conflict has sent oil above $100 per barrel, and the threat to navigation through the Strait of Hormuz remains unresolved. Iran has stated publicly that there will be no negotiations and has begun charging yuan-denominated tolls on Hormuz oil shipments. That last detail alone should make every currency analyst in the world stop and pay attention. Yuan-denominated tolls on the world's most critical oil choke point. The de-dollarization of energy flows is not a theory being debated in academic papers anymore. It is happening in the Strait of Hormuz right now. The conflict is evolving from a military operation into an energy crisis, and damage to infrastructure could trigger a supply disruption that feeds inflation directly into precious metals through the recession and inflation transmission channels. Gold dropped 9.6% this past week, its worst weekly performance since September 2011. Gold and silver surged 66% and 135% respectively in 2025, but the 2026 trade has been dominated by violent two-way volatility. Precious metals are being liquidated to raise cash as global markets sell off across every asset class. This is not weakness in the thesis. This is liquidity stress creating forced selling that has nothing to do with the fundamentals of the underlying metal. One analyst framed it perfectly. The tourists and retail momentum chasers who piled in during the 2025 rally are leaving the space now. That is probably exactly what is needed for gold and silver to take another leg higher. JP Morgan's global research team sees silver averaging $81 per ounce in 2026, more than double its 2025 average. Analyst forecasts range from UBS at $85 to Gold Silver's Alan Hibbard projecting $175 or higher. The consensus band from ING, Saxo Bank, Bank of America, and HSBC clusters between $55 and $70 for the average. But several analysts have openly stated that actual prices could overshoot that range given the structural forces in play. The gold-silver ratio sits at 62 as of March 26. Historically, in major precious metals bull markets, that ratio compresses toward 30 or even 15. If gold holds above $4,500 and the ratio compresses to 40, silver is north of $112 without a single new variable entering the equation. Everything I just showed you about the paper market assumes the April delivery window passes without incident. First notice day is 3 business days away. 9.2 million ounces remain standing for delivery. Registered inventory is draining at 13.2% per month, and 131 trading days is the clock that nobody on Wall Street is publicly talking about, but every vault manager is privately counting. Here is what I think happens next, and I want to be clear. This is a logical projection based on the data, not a prediction, not financial advice, not a guarantee. If registered silver continues to decline at the current pace, we will see COMEX inventory stress reach critical levels before summer. If China maintains its export restrictions through 2027 as scheduled, the global deficit will widen further. If the Iran-Hormuz situation escalates into a sustained energy disruption, inflation expectations will reprice aggressively, and the Federal Reserve, which is already facing a market that no longer bets on a single rate cut in 2026, will have zero room to provide the easy money that risk assets need. In that environment, physical silver becomes a triple identity asset: industrial, monetary, and strategic. And the paper pricing system that has governed this market for decades may simply stop being relevant. The question is not whether the paper market breaks. The question is whether you are positioned correctly when it does. If this video made you think differently about what is happening right now in the silver market, hit that like button, share it with someone who still believes the paper price is the real price, and subscribe to this channel so you never miss a single data drop. I want you to do something for me. If you watch this entire video, drop a comment right now. Just type OG John AG 2.0 because I want to see exactly how many people in this community understand what 131 days actually means. The ones who leave that comment are the ones I am making these videos for. This is OG John AG, logic over noise, data over drama, and right now, the data is screaming. The clock is running.